Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over the great real estate bubble of the 1920s. I don't think a lot of people know that there was a huge real estate bubble that popped in the 1920s, leading to the Great Depression, in my opinion. I'm going to cover the article. A lot of people think that it was a big stock market crash, but in my opinion, it was real estate that drove it. And I'm going to give you some information about the great real estate bubble of the 1920s so you guys can get a little bit more information about it. So let's dive in here and I'll show you what I mean by it. So economists conventionally attribute the Great Depression to blunders by then new Federal Reserve Bank, according to the story promoted by Milton Friedman in the Chicago School after the stock market crash of 1929. The Fed kept interest rates too high, strangling the economy is what his opinion is. But there's a different story. The story of the giant 1920s real estate bubble. It began with cars. So in 1899, the auto industry took off exponentially. And it peaked, the production peaked of over 4 million vehicles in 1929 before collapsing. It did not again pass 4 million until 1949. The auto suddenly opened up vast suburban and rural areas to housing. Developers, legitimate and bogus, leapt at the opportunity. Banks jumped into creating so-called shoestring mortgages, effectively allowing property purchases on margin. Within a few years, tens of thousands of acres around major cities had been subdivided and sold. In rural areas, developers bought up farms, dug a pond, built a clubhouse, and sold cheap vacation lots, as reported. 100 years of land values in Chicago from 1918 to 1926, Chicago population increased 35% and land values rose 150%, or about 12% a year during that 1918 to 1926 timeframe. In 1926, land values stagnated, then fell. By 1933, Chicago land values had fallen some 70% overall. Peripheral areas fell even more dramatically. After 1929, remember 1929, home construction collapsed and paralleling the auto industry did not again pass the 1926 level until 1950. Remember, the thesis of the channel is housing starts or home construction. After 1929, home construction collapsed. There's your deflation. It's a deleveraging. Nationally, there were an estimated 20 to 30 million vacant lots. Deflation. Compared to about 30 million occupied housing units. According to economic historian Alex Field, the barren subdivisions ringing the cities hindered the recovery of construction, missing titles of defaulted owners and poor physical layout created by de facto brownfields. So the real estate bubble helped set off and then worsen the depression. Collapsing land values left people suddenly much poorer, so they cut spending. They also defaulted on mortgages, sticking the banks with toxic assets, liens on near worthless property. The struggling banks, in turn, cut off lending even to good customers. Bank runs, panicky depositors withdrawing cash, further crippling the banking system. Between drops in spending and lending, businesses failed, unemployment soared, and prices fell. Thus, a radical innovation of the early 1900s, the automobile, set off a destructive real estate bubble in the 1920s. Another radical innovation took hold in the late 1990s, securitization. That is, the aggregation of consumer debts, especially mortgages, into marketable packages known as collateralized debt obligations. Set off another giant real estate bubble by making houses affordable to poorer Americans. The collapse of the CDO bubble stuck banks again with toxic real assets. Fortunately, economists and markets now recognize that to limit damage, we must force banks to write down the garbage quickly. But write-downs will reveal that some big banks' liabilities exceed their assets, requiring drastic remedies, including restructuring, breakup, and possibly temporary nationalization. Unfortunately, so far, our new Treasury Secretary, Tim Geithner, either lacks the nerve of the authorization. Unless he acts soon, we face another lost decade like the 1930s. And I wanted to go over this because I don't think they tie these crashes to real estate. And real estate is a driver of money creation, which is expansion and contraction. So I wanted to go over this, and I'll put in the link the link to this article that I just read here for you guys to view and read on your own. But the expansion and contraction of credit is tied to real estate. And in this particular problem in the 1920s, we saw that we had a real estate boom in the late 1910s, early 1920s. It was booming, booming, booming. And they got really easy with lending money. And that deflation or deleveraging on the backside is what collapsed this whole thing from the real estate market. So when we're looking for booms and busts, we have to look at the real estate market. And I've got some other examples that I'm going to share with you guys in another clip with Japan's real estate market, America's real estate market, and where we are today. And it does touch on the thesis a little bit of the channel. But this is one thing I don't think a lot of people really understand about the 1920s. They just think it was the stock market collapse. It was the real estate market driving all this. And it started to really start having problems in I would say, mid to late 1920s, 26, 27, 28. And in 29, it manifested itself. When you look at the last bull market in commodities and real estate, so that was the mid 2000s. That last bull market, it started having problems in 05, 06, 07. Like that was kind of the first problem areas. It was starting to come out. And I can show you in the other clip how the housing starts reacted to all that. It started to decline in 06. The crash happened a few years after in 08. So it takes 2 or 3 years for this Titanic. It's a big Titanic ship that we're navigating here. And it takes time for this stuff to navigate in turn before the crash actually manifests itself in all these other assets. Inflation takes a good 2, maybe even 3 years, depending on how you print things, before it shows up. And we can have these up and down pullbacks and all over the stuff, all over the place. And everyone's so short-term focused, even when I read in the comments that they assign something to the short-term movements. The big long-term movements is what move things in the big direction. But in the short term, things are going all over the place. So you can't assign short-term movements to long-term trends, cyclical versus secular. And some of them are so small that a 50% decline in some of these assets is actually quite normal, especially in the volatility that we're seeing in today's markets and the way that information moves and spreads and money flows. It's getting pretty ridiculous. But I also think that's inherent to the end of a credit cycle or end of a money system. It becomes more volatile and we'll call it less stable because everything's moving around and money's sloshing all over the place. So that's hopefully you guys got something from this. The great real estate bubble in 1920s. I'm going to go over some more clips after this one, going into some of the charts and what we're at and demographics and population and what kind of drives all this. Give you guys a little bit more information on why I don't think a crash is coming and why I don't believe that we're in a deflationary cycle. We are in an inflationary cycle, in my opinion, because of the lending and real estate market. If you guys like this analysis, give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.